Because tonight we're going to talk basically about three things. We're going to talk about what's gone wrong and what is uncomfortable and uncertain and sort of negative right now, has been and is. We're going to talk about the clear and present, current, what's going on, what are we seeing right here, right now. And we're going to talk about some good things, good to great, and what we see for a future. So what I did was I created one version that starts out with the negative and finishes with the positive, and one that starts with the positive and finishes with the negative. So I was just really curious, who in the room, when you're hearing something, if somebody comes up to you and says, I've got good news and bad news, which one do you want first? Bad news. I got the right one. So I created both and I decided, I thought you all would choose that. So that's where we're going to start. We're going to start with the reality of what has happened and is happening. And we're going to finish strong, not only with some positive, but with some dessert also to go with it. So you'll get the cherry on top, both with the food and the presentation. So as I mentioned, we're going to talk about the not so good, the current, and then also what we see that is good now and in the future. And I'll just keep the teaser out there. There are some things that I'm very excited about. And I don't want to get away from that while also staying focused on the reality of there is some discomfort at the same time. So we'll cover both. This is simply what we all know is that the market had a bad year last year. By any measure, you could say it was down anywhere from 15 to 20%, and even upwards of 30 to 35% for the NASDAQ and some more tech-heavy investments. So across the board, this is just anybody in the room probably, maybe you wouldn't get the exact number right, but anybody could have raised their hand and said, rough year. Question for you. Your traditional 60-40 portfolio, 60% stocks, 40% bonds. Armin is not allowed to answer any questions tonight. He always tries. Cindy, you got to control him. You've been trying for a long time, haven't you? Traditional 60-40 portfolio, 60% stocks, 40% bonds, kind of your staple for how to manage risk, right? Historically, if stocks are struggling, bonds are supposed to be performing better. If you're retired, you're supposed to own less stocks, more bonds to get more balance. So last year, I want to say anybody besides Armin, but anybody besides my team, what do you think the average 60-40 portfolio performed at last year?
Minus 15.
Just, yeah, go ahead and raise hands so I know to call on you. Bob?
Minus 20.
Nailed it. So I'm going to show you a lot of charts tonight, and don't worry if you can't see them clearly. Don't worry if it's sort of tiring to see all these charts. I'm going to tell you what the takeaway is from each one. And the takeaway here on the far right is last year, a safe 60-40 portfolio was down about 20% last year, okay? S&P and the aggregate bond index. Now, the thing that was really tricky and actually first time in history was what we saw. This is the attribution of stocks and bonds. The blue is the stock market. We know that went down. But what was really impactful was the first time that the bond market went down so significantly the same time as the stock market. The only thing that did well last year was some real estate. Not the only thing. Cash did well last year. But a really tough year because when you look, the other down years, you see the blue, which is stocks, were down, but bonds helped the portfolio out and helped avoid some of the loss in an overall portfolio. Last year, we didn't have that. The aggregate bond index was down about 15% last year. So the blend together in a safer portfolio, very, very odd dynamic to be down, as Bob said, about 20%. Well, so not true that bonds are never down. So Jay's question is, what happened? Why would that happen? Bonds are never down. They do go down, but They haven't gone down in 35 years, which feels like never, right? So think of bonds two ways, first of all. If you buy a bond directly, let's say you buy a US government bond paying 4%. If you buy that bond and you hold it to maturity, let's say it's a 10-year bond, you hold it for 10 years, you're gonna make 4% a year for the 10 years, and you don't lose money. But along the way, the value of that bond changes every single day. A good relative story here would be your home. We think our home never goes down in value, right? We think real estate goes up all the time because everybody sells their house for more than they bought it for, almost everybody. The reality is, your home or any real estate changes in value every single day. Just ask Zillow. But we don't know it because we're not selling our house every day. So the environment's changing. For bonds specifically, they are valued based on where interest rates are today relative to where they were when you bought your bond. So what I mean by that is, let's say you bought that 4% bond again. You hold it to maturity, you made your money, you're fine. However, if over time in between the 10 years, if interest rates rose to 5, 6, 7%, the value of your 4% bond went down in value because whoever's buying that bond from you has to get the equivalent of 5, 6, 7%. So they're gonna pay less for your 4% bond than they would for a 5, 6, 7. Now, as I mentioned, we've been on this historic bull market in bonds especially, where for 35 years, interest rates have been on the decline. So not only, if you owned a bond that you bought 30 years ago, and you held it for 30 years, not only did you get a high interest rate from the coupon on the bond, but you also saw that bond greatly appreciate in value because maybe you got a 10% bond back in the day and rates went all the way down to 1 or 2%. So they do move every day, and now for the first time, that bubble has burst, the bond bubble. Interest rates have gone up, are going up significantly, and because of that, last year bonds got hit hard. The anomaly was that it's been 35 years and that it happened the same year that the stock market was down so much. Very, very odd. So, corporate earnings, S&P 500 companies, their earnings growth. This is really fundamentally what drives the S&P 500 and stock market performance. We talk about things like Russia and China, and we talk about things like COVID, and we talk about certainly interest rates and how all these come together to affect the market today. But fundamentally, what drives stock market performance over time is corporate earnings. How is corporate America doing? Because it all funnels up to corporate America. If interest rates are on the rise, it affects them because they're paying more to borrow money than when rates were lower, and that affects their earnings. If employment market, labor markets have been tough the last couple of years, if you own a business or manage people, you know that it's hard to hire people right now, and therefore you have to pay more to hire good talent right now. Well, when that happens, that's a bigger expense to corporate America, affects their earnings. So all the other factors affect earnings. And what you see here, what I want you to take away here, is earnings are on the decline. So third quarter last year, they got near zero. What did corporate earnings do fourth quarter last year? And if you get close, I'll give this to you. You don't have to nail it to the decimal. But please raise your hand so I can hear you correctly. What did corporate earnings do fourth quarter last year? Harmon's itching. Somebody said 6 and I didn't. Who said that? Plus or minus? Plus 6. Okay. No, I can't give you the plus 6. Any other guesses?
-6.
I give him credit for being smart enough to realize that I was kind of trying to get it out of him. All right, so sorry? 1%. So nobody is real close, but I'm going to give the prize to Brian. He got the closest and used a little bit of logic to realize from the question I asked Jay. I think you have to give Jay an assist. About -4.7, close to 5%. That's significant. That's a major change in our economic environment and corporate earnings environment. And it's really important now that we watch what the next couple of quarters do. You know, we don't know the first quarter yet, but it's going to be really important to watch and monitor because everybody's looking for, are we in or heading to a recession, and what's the economy doing next? This is going to be a key factor, is what do earnings do to follow that tough fourth quarter that doesn't quite show up on the chart. So what we see here is some gauges on the overall economy. Again, I want to hone you in on just a couple of key factors here. I don't want you to take in the whole chart necessarily, but GDP growth is after decline in the first half of last year, came back fine the second half. We seem okay there. Labor market, people are employed, which is great. There's not a ton of people looking for jobs. Now, lots of you probably want to raise your hand. A lot of people have taken themselves out of the labor market, meaning a lot of people that maybe were going to wait another 5 or 10 years to retire after COVID or after whatever stress in their lives, they said, you know what? I'm just going to call it quits. So a lot of people have taken themselves out of the labor market, which affects these numbers. And we are, as I said, if you ask, in fact, I was at a business like CEO, executive level meeting the other day, and they interviewed they surveyed and asked, what are the 3 biggest challenges in business right now? And it was 3 different answers, but the 3 answers were basically labor, labor, labor. It was like finding people, getting good quality people, and then paying good people. It was all just 3 different areas of labor. So it'll be interesting to see. We haven't really seen salaries, wages go up significantly yet. We would expect to see that next, especially as we see demand for labor go up, you would expect then the wages to follow that. Another thing that we're keeping an eye on. Inflation certainly got out of check, peaked out. I'm going to have another slide here. Peaked out at 9%. Some of you will probably want to heckle me over this, but inflation is coming down. Of course, we could argue about how it's measured, what they've eliminated, how it compares to what they measured in the past. I like to get all that out there to prevent you all from heckling me. But it is, by whatever means or measure, it is coming down. It's come down from that high of 9 to the 6, 7 range. And I expect that to continue to come down. The forecasts are it'll get back down to a 4 or 5% range. Of course, forecasts are forecasts. I like to say, people say nobody has a crystal ball. I say I've got one. It's just not perfectly clear. It's just a little cloudy, but it's there. Consumer sentiment is interesting. I'm going to look at that later. But the segue I really want to make is this housing measure, and I'm going to show you some thoughts around housing. This measure here, as you can see, declined from Q1 last year at 79 all the way down to 33. This is them asking home builders how they feel, what their sentiment is about the real estate market, right? They have a pretty good finger on the pulse. Now, I was talking to Bob, whose kids just bought a house in the Charleston area, and he talked to the people at Lennar Homes, one of the biggest builders, and they said, we're not slowing down at all. We got our foot on the gas pedal, pressing along. Now, Lennar can do that. They're big enough and strong enough to do that, and if the market declines on them, they can survive that. But your average home builder is worried. They realize the market doesn't always stay like it was the last few years. So, and you can see that here. Clearly, they're worried. It declined from 79 to 33. So the other thing that I think is extremely top of mind for me as far as the housing market, I was already thinking this, and I saw a slide the other day that made it crystal clear. My next question for a prize is, how much do you think the cost of home ownership has increased over the last 1 year, 12 months? On a percentage basis, what percent do you think the cost of home ownership is? Let me clarify that a little bit in case the question doesn't make total sense. What is the monthly payment for a house today versus what a monthly payment would have been on that same house 12 months ago? 35%. So I have a problem here.
Don't call him
He didn't raise his hand.
He did. He just didn't wait.
I didn't call on him. And he already won a prize.
I get his prize. Jay gets it. Yeah.
You can decide if you give it to Jay or Tammy or Melissa. So the answer is correct, though. And I'll discern this graph for you. The cost of home ownership has doubled in 12 months. Take that in for a minute. We all knew that home prices were up. In fact, some of you are probably wondering, well, wait, home prices are up 20, 30, 40%. What do you mean double? Well, the blue line, which shows about a 40% increase, this is the Case-Shiller Index, which is a measure of home values. So yes, the value or price of homes went up about 40%. Before I move on, I do want to point out, you'll notice the blue line is starting to tick down a little bit. We did see a slight decline in the 1% to 3% range over the last few months. I do think that's going to continue and probably get worse. We can debate that after dessert. So that's home values. Now, piggyback home values with the fact that most people get mortgages on their home, and that what was a 2.5%, 3% mortgage a year ago is now 5%, 6%, 6.5%. So when you combine and piggyback those mortgage rates with the cost or value of a home, you get this red line, which comes all the way up to 100%. The cost of home ownership has doubled in a year. That is this kind of reminds me, even as I say that, I'm not sure that I can allow that to impact me as significantly as it really is. And it reminds me of, now we talk about the government printing trillions of dollars or trillions of dollars of debt. We talk about, trillions like it's nothing. We know it's a big deal. But 5, 10 years ago, in these sessions, we talked about the government throwing around billions like it was no big deal, and billions was a big deal. Now, like, trillions is the new billions. And I feel like that about this. Like 100% is almost hard for us to wrap our heads around and even recognize the impact. But as I move on, I just want to make it clear there, my foggy crystal ball, I do believe that home prices will continue to come down. I don't know if it's in the 5% range or if it's in the 10 to 20% range, frankly. I don't think anybody can know. We've got some real estate people in the room that would have their forecasts. But the reality is, because for a period of time, the talk was, well, everybody's buying with cash, so it won't impact them. That doesn't last long, right? The homeowner in New York decides to move south, sells their house, for quadruple what they paid years ago, brings that cash to Atlanta or Florida, so they buy cash for that house. The first-time home buyer 5, 10 years ago then sells their house and is able to take that cash from the appreciation to buy the next. So that works its way through the system and lasts for a little period of time, but it's not sustainable, and that's mostly worked its way out of the system. You even have business owners and inheritance that have worked their way through the system, but eventually there's always going to be cash buyers, but most people are still going to predominantly need a mortgage. So I do think those prices will come down. I've talked to a lot of people. I mean, a year or two ago, I was telling people, I said it a lot here, if you're thinking about selling your house, I said, make sure to get it on the market and sell it. And a lot of people took that advice. I had a lot of clients come back and say they were really glad. Some of them nailed it, got it just at the right time. Some maybe a month or two off, but they got it right. My best guess, if you're buying, ideally, I think you probably wait 6 to 9 months, or at least a couple of months to see how this bears out. Maybe it'll become clearer in the next couple of months. I do know some people that have bought in the last month or so, and sometimes you got to do what you got to do, but it's probably not the best time to buy. All right, so that's the rear view mirror. Let's take a look at the current, which isn't much prettier, maybe not prettier at all. If you've been to any of our events, or if you've watched our market updates that we put online, some of you don't know us or new to the firm. We do a weekly market minute video. We have it on YouTube and we have it on our website. Just a quick commercial. If you do want to check us out, wealthep.com. And on the blog, we have every video for every week. We post a different video, different advisors on the team. And you see this occasionally. These are Rockdale speedometers. CNR, National Rockdale, is a great wealth management and financial firm and a bank. They've been doing these speedometers for decades and decades. They have a very good track record, not so much of forecasting the market, although it is to a degree a forecast. What you find when you look back historically is when these have a lot of green, the economy and the market are in good shape. And when you see more red and yellow, it's more like 2008 and 2000 and tough periods before that. So not long ago, a year ago, this was pretty green. As you can see, all red and yellow. We have no green on here. Some of the speedometers or indicators are going to be a geopolitical risk. That's not too hard to figure out. We got Russia and China causing problems, disturbances. We got balloons flying over our airspace that we have to shoot down. It's a little bit uncomfortable. So that's kind of obvious. Interest rates, obviously higher. That's affecting housing. It's affecting businesses. It also affects consumer spending, right? If you're somebody who's going to finance a car, if you're thinking about buying a car and you have to finance it, Does the fact that rates are 6 to 8% versus 1 to 3% affect your car buying decision? Certainly affects some people, affects the home decision. Not to mention, it affects people that use credit cards regularly, right? They may not buy the clothes that they were gonna buy on a credit card that they're not gonna buy now because rates are higher. Now, we would probably all agree it's better that they don't put that on a credit card, but at the end of the day, it affects consumer spending. The one that we've seen change recently, leading economic indicators, which I'm gonna go into a deeper discussion on, there's 10 economic forces that affect the overall leading economic index. And in conglomerate, that gives us a lot of information about where the market is heading and where the economy is heading. So we're seeing this, it's gradually slid from green to yellow to red, which is not ideal, not surprising, but not ideal. So a little bit more, like I said, on the leading economic indicators. This shows, just going back to 2000, what happens when those leading economic indicators are on decline year over year or 6 months over 6 months. What you see here is the percent increase or decline in the indicator. It's not today's number, but it's where it is relative to where it was recently. And these sort of shadow boxes are recessions. And what you probably notice, without having to see the numbers or really get into detail, you can see that when the line drops below zero, I'm not going to give a prize for this one, it's too easy. What happens shortly after the line drops below zero? Recession. I'm glad y'all were paying attention. Okay. Now the question going back is, this only goes back to 2000. If I go back to the 1950s, 60s, how often, when this drops below zero, do you think a recession follows? What percentage of the time do you think a recession follows? All right, you all get a prize. Now, I'm going to accept 100% as the answer. Yeah, you get dessert. I don't know who said that, but I like that. I like that for the prize. I'm going to accept that for the answer. It does, for example, here in 2016, you see it kind of just maybe barely tip below the line. So you do see periods where it kind of touches it, gets a hair below. But when it really meaningfully drops below, as you see here, I mean, this one's COVID, that was the strangest recession ever, right? It was an overnight recession, and the next thing you know, it was gone as the economy opened back up. But it still followed the rules, right? It dropped below zero, and next thing you know, you've got a recession. So you're probably not surprised that so far everything I've shared with you does point to a recession being likely either now or in the near future, right? Isn't that really great news that I'm sharing with you? I told you, I promised that I would end with the good news though, right? We're not there yet. We're going to get there. This is a great report. These two companies got together, Franklin Templeton and ClearBridge, and every month they update this anatomy of a recession. And they look at a lot of different areas of the market. I can get this to you if you want it. Obviously, you're not going to be able to read it up here on the screen. But it looks at everything from the stock market to the housing market to a lot of the things that we talked about. It grades each one of them. You can see the green, yellow, red. And then it gives an overall indicator on the bottom that you probably can tell isn't heading in the right direction. So a few months ago, it was green, meaning a recession was very unlikely. In July, it turned yellow, meaning 50-50-ish. And for the last couple of months, this indicator has been in the red, big red X. So they would say that means, it doesn't mean 100% chance of a recession. Sure, it looks that way. But with everything I've shared so far and everything on here, you would say, well, gosh, it sure looks like 100%. They would say we're at about a 75% chance that we're heading into a recession. And frankly, today I pulled up 5 or 6 different indicators and companies that look at recession forecasts. And the range of a likelihood of recession was anywhere from a low of about 40% to get this, a high of 98%, pretty close to 100 there. But that's a pretty wide range. But I'm feeling Franklin Templeton here in ClearBridge. I think 75%, if I was giving my own score, I think I would say 75% is a pretty good number, but not a good number, right? Not one that we like, but I think that's a pretty decent forecast. Now, I feel like I've given you a lot of tough news, so I'm not going to wait until the end. I do want to share this right here in the interim. Unfortunately, we all want a clear rule. When this happens, we're in a recession. That is not how recessions work. There is actually a committee that gets together, economic committee. They look at GDP, they look at markets, they look at a lot of different factors, and what's really odd about it is they actually call a recession in hindsight. 3 to 6 months after it's happened, they say we were in a recession 3 to 6 months ago. So that's why it's important to look at the things that we're looking at, right? We don't want to wait until we're in a recession to be thinking about home prices and salaries and spending and everything else, because then it's too late. So to answer your other question, I would say even though there isn't a specific rule, I would say where do we measure right now against the likelihood of that committee saying we're either in or heading close to a recession? I would say we're probably around that 75% likelihood that we're pushing that figure, that we're getting there. So I know we want a black and white 2 quarters. Now, okay, if you've paid attention, you might question me on, now I'm gonna have to go all the way back and back forward. Okay, why wasn't this a recession? Actually, this makes the point. Why was the first half of last year not a recession? It's 2 negative quarters in a row, right? Minus 1.6, minus 0.6. This is actually, sorry?
Because Biden won't admit it.
Oh. So this is proof of what I was sharing, right? The general rule of thumb that 2 negative quarters makes a recession would say that was a recession. But the committee got together, and because it was relatively small negative growth, they deemed it to not be a recession. We can talk around our tables about that. Okay, but think about it. So I'll play devil's advocate because I know a lot of us are thinking, well, that sure seems like it would have been a recession. Devil's advocate, unemployment was low, earnings were good for corporate America, people were spending, housing prices were going up, car prices are ridiculous. I'll share my story about trying to buy a car for my son if you want to really have fun with that. So there is some logic that even though, one, it only barely tipped negative, and then there were a lot of positive forces going on during that 6-month period. All right. As we've done these over the years, in fact, I went back and watched and looked at Armin in the middle of 2020, when the pandemic had just hit. We recorded a couple of these in my basement. We did it virtually, sent some of you some pizzas at home so we could still have dinner while we were presenting. And one of our themes back then was don't fight the Fed. And the reason we were talking about that was there was a couple of things going on. There's really 2 factors here that I'll reflect back to 2020 and I'll also talk about today. So in 2020, when COVID hits, what you see is the federal funds rate, which is the rate that banks borrow and lend to each other, right? It's overnight lending. Banks will supply cash to each other as one needs some and the other takes, or the government gets involved in this too. The Fed plugs money in. So before COVID hits, they're lending at mid-2s, 2.5%, let's say, and almost overnight it goes to near zero. 0 to 25 basis points, 0.25%. So that was one way that we look at don't fight the Fed. When that rate is lower, and you can see it going way back, I mean, this might shock some of us, right? Some of you bought homes in the 80s. I know Armin's one, he wants to raise his hand. And you paid double digits to 20% plus mortgages in the 80s, right? And y'all are like laughing at us now, like 6% interest. What's your problem? I paid 22% in the 80s. I didn't. So obviously, big dramatic, really over that extended period of time, the Fed was making it easier and easier to access capital because this made mortgages more affordable. It made it more affordable for corporate America to borrow money, to invest in new businesses and new services, made it more affordable to buy cars, to buy clothes on credit, everything across the board. Started to climb back up. What happens is as the economy is in good shape, as it was in 2018-19, interest rates are supposed to go up. And that's how you keep inflation in check. And one of the things, if you've been coming to these long enough and you listened and have a good memory, you would recall that you heard me kind of stomping my feet right here. I probably left a shoe mark on the ground here, that I was frustrated that the Fed was waiting to raise rates, because what happened was the economy was improving, it was in good shape, and the risk was they weren't raising rates, which meant the consequence was that eventually we were going to see inflation. Of course, right? Now it's clear and present danger. So that's why the Fed does vary rates. The idea is they raise rates when the economy is in good shape to keep inflation in check, and then they lower rates when the economy is in a rough period to try to boost the economy, to boost borrowing and spending. So we see them go to near zero. Don't fight the Fed meant they were supplying easy cash, which helps boost the economy. Well, now we do see them finally raising rates to get inflation in check, right? Should have done it a long time ago. Yes, the pandemic caused a disruption and changed the whole environment, but they should have raised rates prior to that to try to keep this inflation in check. But there's a second factor, and maybe as or more significant. M2 money supply. Very simply, most of you probably didn't get an economics, MBA or degree. I didn't get the MBA either, just an economics degree. M2 simply is how much cash is there in the system in the United States. You can look at this for any country, but this is the United States. What do you see? Might not be able to tell the year, but you see steady growth. And if you went even farther back, what you see is M2 money supply is supposed to just grow with population growth effectively, just this steady growth. What happens in 2020? Who can answer how much growth that is quickly? What percentage growth is that? Bob? 42%. You get another prize. Kathy's going home with the whole table. About 40%. Comes back to somewhat normal growth. It looks escalated here, but now you're looking at the effects of compounding. But what I want to take away today is something we haven't seen in an extremely long, actually haven't seen it ever, is this. We have not seen a shrinking money supply. Again, don't fight the Fed. The combination of these two things, one, the fact that rates are going up, which makes it more expensive to borrow, which makes it harder to spend, and cash is leaving the system. Instead of the Fed buying bonds and plugging a lot of money into the system, they reverse courses and are taking cash away. Now, that sounds pretty bad. It's not great, but I do want to hedge my comments a little bit in that if I drew a straight line or an exponential growth line here, we're getting close to getting back online, right? So you could argue that it's not really a big problem because all they're doing is correcting back to what happened after the pandemic, right? They put 40% extra in. Now they're just getting back to normalized growth. So not necessarily the end of the world, but when we take our perspective right here, right now on what do we think of the economy, if rates are going up and the money supply is going down, well, we have to infer from that again, that likelihood of recession, likelihood of a tougher time is hand in hand. Okay, this is a slide that I think is very significant, pertinent. I think it's something that's on a lot of people's mind, and there's a couple of different perspectives on this slide. What this is telling us, number one, super obvious, government debt is through the roof, right? So the blue line is the amount of public debt, kind of level, comes up steadily, levelizes, and what we see is obviously a huge jump in 2020. That's when we were giving the presentations and we were talking about the government was putting $7-8 trillion into the system, throwing around these numbers like they're not significant. And we said it's inevitable. There's no way you're not going to have inflation a couple of years later when you add $7 or $8 trillion to the system. But this red line is really important because what we shared then was that while the amount of government debt is absurd, and none of us would be okay with that if it was a relative basis on our personal debt, however, the cost of servicing that debt was relatively low. So if you're a corporation and you're looking to buy another company, if you could borrow at 2% and make a 10% return on your investment, you would say that's good debt in the business world, right? You're getting an 8% spread, There's a lot of margin of error for minimizing risk. And you would call that good debt that's serviceable. Well, not saying the government debt was good. We could all argue their spending. But through this period, the cost of servicing the debt still hasn't gotten up to 2% of GDP. It's been in the 1.5% of GDP. The historic average percentage of GDP, cost of servicing debt for the government, is about 2.5%, 2.4%. So, good news, bad news. Good news, well, bad news, good news, bad. Bad, really high debt. Good, still serviceable, even today. Bad, what happens when the government has to start paying higher rates on this huge debt load, right? It's just, we haven't even seen the impact yet, right? Right now, as they issue bonds, rates are higher, but it hasn't worked its way into the system yet. Now, the thing that Armin and I didn't understand, we talked about this, I think even 4 or 5 years ago, when rates were near 1 or 2%, we both asked the question, why is the government not issuing 50 and 100-year debt? Why not refinance all this expensive debt at 1, 2%, lock it in for 50 or 100 years, and we wouldn't have to worry about the cost of servicing debt, right? We'd still all complain about how much debt they have, but if this cost of servicing stayed below 2%, we wouldn't have an issue and it wouldn't affect the economy. But frankly, I am nervous, scared, worried about what happens when the government has to start paying 5, 6, 7, 8, 9, 10% on $120 trillion of debt. You have the answer, Jay?
To who? Pay to who?
Oh, come on. That's a bait. Jay wants to know who they owe the money to. And of course, it's a lot of people. It's Americans. Primarily. It's Chinese. It's corporate America. It's everybody. And I'm sure there's other questions to follow that. So I am concerned. This is my biggest concern about rising rates, right? It's yes, I don't like the amount of debt, but my bigger concern is what the cost of that's going to be as rates go up. Now, I'll finish. I said, good news, bad news, good news, bad. So the one thing I'll finish on there is the one thing the U.S. government has above everybody else right now, and I know there's questions around this. Right now, they just print more money, right? The government doesn't see it as a problem because if they owe more, they just print more. They devalue the dollar, but because America is still the greatest superpower today, and because everybody still likes to lend to us and still wants to come to us even when we're in trouble, we still are better off than everybody else. Right now, it's not a problem, and I know you've got questions about when does it become a problem and what do we do? All right, I promised a positive outlook. So first of all, because the market has declined, we've seen PE ratios, which is basically it's price to earnings, it's the value of the stock market. We've seen that number come down. This is important because historically what happens is when the market is overvalued, it comes down. It's what happened here, overvalued. This top line is a definition of overvalued, market comes down. When the market is undervalued, it tends to come back up, reversion to the mean. So we saw the market come down last year. Good news is now we've got stocks that are relatively fairly priced. A couple of weeks ago, actually, when we did this chart, it was a little bit undervalued. January was a good month, so right now we sit pretty close to fairly valued, which would be a positive relative to how overvalued they were for a period of time. So that's data point number one on the positive side. Data point number two, you heard me mention earlier, and I just want to reiterate, inflation is improving. I think the Fed was late. I think they should have raised rates years ago to get ahead of this. I think also printing $7, $8 trillion and giving it to everybody caused inflation as well. However, it is coming into check. You do see the line coming down, and we are seeing that number move from 8, 9 down to 7, 6, probably heading toward 5, hopefully 4, but it is going in the right direction is the most important thing. Also, we're not there yet. Right now, we're still in a higher and possibly rising interest rate environment. My foggy crystal ball forecast is that we'll see this, and I started this probably a year ago. Well, the forecast really started like 14 years ago, but the more recent part, about a year ago, I said the government will finally start raising rates, try to get inflation in check. Then, what is likely to happen is there'll be enough pain in the system that they reverse courses and then start to lower rates. So best guess is they probably raise rates another 1/4 to 3/4% over the next few months to the rest of this year. Then, as this bears out and we see the likelihood of a recession and we see the impact on the economy, it's likely the government then, the Fed, turns around, lowers rates, which would then stimulate the economy back and stimulate the stock market back. So the good news here is we seem to be getting to the end of the road of the rising rates and nearer to them reversing courses. And I don't think it's going to go back to near zero like it had, but I think it'll get back to a normal rate in the 2 to 3% range. This one I call counterintuitive because it just is. They survey, I could survey this room right now. If I just asked everybody to write on a piece of paper a number from 1 to 100, 120, what do you think, what's your outlook on the market and the economy right now? They take everybody's answer and they come up with a total number, and that's consumer sentiment. You would think when that number is high, the economy and the market would do well. Right? Hey, we're really excited. The market's great. We're making money. Jobs are good. Housing is good. So it's going to continue to be good, right? No. These 8 highest points, these dots, the following 12 months, the S&P averages about a 4% return the next 8 months when the average person says, hey, things are awesome. The better we think it is, the worse the market does. 4% is not bad, but when we think it's that the world's coming to an end, when we're at these 8 lowest points, when we say, I can't stand it anymore, there's no way we're going to get out of this. I mean, after everything I just shared, you're probably thinking this, right? Man, you just said, interest rates and inflation and housing and jobs. Of course, we're feeling a little bit low on the consumer sentiment right now. Well, guess what? The following 12 months, on average, the market is up 25%. Now, you might, at this point, think, Darrin, you're kind of contradicting yourself. The first half of the presentation was everything about heading toward an economy, recession, and a dip in the economy. Now you're telling me that stocks are fairly valued and the market goes up after consumer sentiment is low, et cetera. And that's the reality of economics. There is usually good and bad information. It does happen where it's one side or the other. But how I think this balances out right now is my personal opinion. I may or may not represent all of Wealth EP, but my personal opinion is we've got some pain to feel in the next, let's say, 6-8 months. And after, this is my exclamation point, I believe, call it 12 to 36 months out. I know that's a pretty big range, but I think after we work this through the system, I believe we will have a tremendous, awesome, fun bull market that's going to be driven by a lot of investment in innovation, technology, healthcare, all of it really innovation technology that's going to drive every area of the market, education. And what we see historically are these long cycles where most of these charts really point to the same thing, but you'll see it here graphically more easily. The top line, the blue line, shows these long 20-year periods where the market and the economy tends to do extremely well. The first one is 1942 to 61. The next one is 1980 to 1999. The first one was coming out of a war, and that was all the stimulus coming out of the government to invest in the economy and invest in people coming out of the war. But huge dramatic impact. Market averages about 18-19% a year for 20 years. The next one is what I would call the technology boom, especially the late 90s, where that was when we used to joke a monkey could throw a dart at a dartboard and buy any investment and make lots of money, right? That was true, and what we saw was a 20-year period with about an 18% return. I lied a little bit on the first one, it was about 17%, not 18, 19. On the flip side, you see these somewhat shorter periods, call it about 10 years, where the market doesn't do quite as well. Even over those periods, you still see positive returns in the market overall. You'll have negative years like last year, but the average will still have some nominal returns. But I believe that as we come out of this pain that we're in right now and probably going to last a little bit longer, I believe we'll be in one of these late 90s huge bull runs, because if you just it's tremendously exciting. There are a little bit of concerns, when you think about what can happen with AI as an example, right? On one hand, artificial intelligence is going to take our economy to another level, right? The efficiency and productivity that's going to happen in cars in education and teaching, robotics and manufacturing, et cetera, et cetera, et cetera. Tremendously exciting, and it's going to cause the stock market to just run, I believe, probably for at least a decade. To come with that, it's a little bit scary to think that there's going to be computers and robots that can look and act like humans and can drive like humans and make decisions like humans. So we could debate that as well. I'm here to talk about the economy and the stock market, and from that perspective, after we get through this pain, I'm expecting a really exciting bull run that I hope we all get to enjoy together for a good decade plus. All right, I promised the positive punchline. I gave you the dessert in the presentation and the dessert on the table. I don't know which one was better. Hopefully you enjoyed both. Are there any other questions that I could take? And I'll take a handful, and then I know that some people want to sit all night and do Q&A. Some people probably want to get home to bed, so we'll take a few, and then I can take some others one-on-one.